Okay, Sunday, January 22nd, 2017. We're going to look just exclusively at Natty this morning. Natural gas, I wrote to be a little bit on the defensive side on natural gas, and it's looking like it's beginning to falter here under $4. This is how I'm looking at Natty. Okay, first off, all right. Chart going back, whatever, 40 years kind of thing. All right. So Natty in the past on here, $2 is the low end. They gave it a go to $4. Okay, now we're working on around a little over $3. There's a stopping point, a monthly pivot at 308, and then there's another area of 302, 303. And I'll go through all the charts. On this chart from more research, okay, so we're going back to 1990. Okay, on here it lists the low of Natty gas at $1 and the high of $15. Okay, I love commodities because they don't go to zero, right? Every equity will eventually go to zero. They're just designed to fail. It's just how it works out. Okay. So on commodities, all right, so Natty gas down here in March of last year, 2016, it hit a 17-year low. So my ears perk up. Why? When I hear things like a 17-year low, is because I know that my risk is less. Okay. The problem with most people, the first thing it's their risk management, they immediately get turned on by the percentage points. Okay. Natty gas basically doubled this year. Okay. So if you had any type of vehicle, to me, a bond is the same as orange juice or lumber or silver or Exxon, or it's just a trading vehicle. Okay. Commodities actually have some intrinsic value. You actually have something there. Equities, it doesn't have any value, really. It really doesn't. You know, you have your bondholders and preferred stock and stakeholders and all this stuff. And what's left over are the equities, right? Okay, so and when they're issued, it says that it's only worth a penny. Okay, that kind of deal. All right, so Natty gas basically doubled. Okay, so this is to grasp what's going on here. Okay, is that the margin on natural gas is around $3,400. Every broker is different, blah, 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 yada, yada, yada. But what I want to use are round numbers, okay? What is the total value? So if you say, like if you bought equities or whatever and you didn't buy on margin, okay? Now, if you purchase natural gas, okay, it says the close here at 320, okay? The total value of the contract is $32,000 and change. Okay. And on here, going back to 1990 and 20, 37 years. So here's 37 years. So the low on natural gas is at $10,000. Okay. And here's 32,000. So roughly, I'm just going to say if you go on margin, it's 10-to-1 leverage. Okay. So if natural gas moves 3% and you're on minimum margin, it's going to slice you up or down 30%. Okay. Double-edged sword, the margin. All right. Natural gas is coming back down. Okay. So we're back to this game. On the way of natural gas coming, okay, as natural gas came off the high here of 14, I turned bearish. I turned bullish on the way up and I turned bearish on the way down. And on the way down, I knew they were coming to a level, okay, of support. Okay, it held support 37 years ago, 38 years ago. Okay, it held this support area, or whatever year it is, 10, 20, 30, yeah, 30, whatever years, 36, 30. Wow, it's been that long. All right. I got started in natural gas in 96. Okay, so back to natural gas. Now, they call it the widow maker. It's because we're back to the leverage. Okay. I'm looking at this going, okay, we stalled off at $4. We're working on $3. Will it get back to $2 or lower? I don't know, but how do you handle getting that? Because I don't want to be the guy that has the stop underneath here and it goes to say 161 or 160 and you get stopped out at a 25-year low. Okay, you're following me on that one. So the deal here is it's the deep pockets deal. Now that natural gas is coming back, the bodies are in these things across the board on the contracts. Basically, all from what I've basically witnessed all the way out to November of 2017 for contracts here. So if we do get, there is seasonal weakness into January and February. So if we do get the weakness, how do you handle this? Well, the first thing is I say deep pockets. You have $100,000. Like I said, I'm just using round numbers. The contract is full value is $32,000. The margin is $3,400. Okay, so we'll just use round numbers. So what I'm saying is, okay, you have $100,000. You buy one at say $3. You buy another at $270, and you buy another one at $220. Okay, now if you have the full amount, you have the 100,000. You're in for 3 contracts, right? Okay, so that's one strategy. The other one is if it goes, natural gas goes below 220, then you can start using the margin. Okay, you can put 4 of them on. Okay, because in theory, we'll just use some round numbers. If you have $100,000 and the margin's around 34,000, in theory, what is that? About 27, 26 contracts. We'll say 25 is 4,000. Okay, so you can get 25 contracts for 100,000. Is that right? No, that's the other way around. You got me on that one. Okay, so we'll say a third, so it's 30, whatever. You got me on that. You got it all figured out. 30 of them, 30 contracts or a little bit less. Okay. Love round numbers, but you understand. Okay. So here, as we go into this, if natural gas clears 305, then we're going to probably go over $4. Okay, so you have to be off and running. So one strategy is say if you have 100 grand, is you buy 3 contracts on the way down, or you can wait for it to clear back over 350 and then get in. Okay, and then another way of going at this is selling put options. Okay, so the price of natural gas is coming down. All right, so the value of the puts going up. You're catching a falling knife, basically. So to me, I look at it when you look at selling put options. Okay, I'm writing naked puts. Okay, what that does is if they go in the money and I'm naked, I'm put. Okay, I'm given the long position. Okay, so here as the knives are falling per se. Okay, and it could be a slaughter type of, you have a whole unwinding. Remember how oil went from 147 to 36 and then back up over 100 again? That's unwinding. Okay, you get that unwinding. You can sell puts. Okay, now every broker is different. There's going to be a margin that you hold on here, but you know your maximum. Say if you sell a $3 put, okay, it can only go to 0. The underline, okay, natural gas can only go to 0. Okay, so you know what your maximum loss is on that. Okay, so you can go that way too. Now the problem with futures is that you have to continue to roll. I'm risk adverse. Okay, once something turns, my job is done. I go off to the new hunt. What I do is I'm like an architect or a navigator. I draw the blueprints, but I don't build the house and I don't fly the plane. I'm a navigator. So once, A to B is laid out, I move on to the next thing to go find the A to B. Okay. It's kind of like a fishing guide. I take you to the fishing hole and it's your job to fish. Okay, so natural gas, I'm looking at this, is it's at a 17-year low. Okay, kind of like British pounds at a 31-plus-year low. Okay, that, because to me, my risk is low. Okay, right? That's why I'm looking at, why am I looking? Can natty gas trade sideways for a decade? Sure. It had a couple of times here where it poked at like 380, got over 4. 380 again, pause. But the deal is this is the party, okay? And the thing is staying power. Now you can go out in a natural gas, 2020 plus kind of thing, okay? That's futures they have, but you have to get filled, all right? So here you have an opportunity. The natural gas could have a large, massive unwind, and you're going to want to get in. One, it unwinds because all the bodies are in there and the narrative is winter doesn't show up, whatever, it doesn't make any difference. I don't need an excuse why I'm making money or losing money. Okay. It's you don't see anything on the chart here. Okay. It's kind of like, this was the worst freeze ever. Yeah. Guess what happened? It cratered. I mean, yeah, it went on the way up, but it cratered. Okay, so to me, the narrative's not there. What I'm looking for here, and then kind of put it in between your ears, is say you buy natural gas at $3, okay, and it goes to $4, okay. So on a percentage wise, okay, so that's what are we at? $3 and 4.5. So that's $1.50. So that's 15 grand. Okay, so percentage wise, if you're only putting up 3,500 for margin, you're looking at what, 400 or 500%. That gets people excited. But for those of you who have the deep pockets and you buy it at 30,000 and you sell it for whatever 6 or 9 months later for 45,000, are you happy? You know, you made 50% in 9 months. You know, I like I said, this is just a rough thing. Are you happy with 50%? Yes. Okay. All right. So that's how I'm looking at it. Like I said, natural gas doubled. Okay, the underlying thing doubled, 160 to basically a little under $4. So it was actually more than doubled. Okay, in 9 months. Now we're getting a decent pullback here. The pullback, this is probably going to be an intermediate type sideways. Okay, because I look at natural gas as basically after coming off of the high up here of 08 is basically a longer sideways pattern. Just like here, natural gas had a longer sideways pattern. I don't know how much is in storage. I don't know what we're drilling. All I know is the price. Is the price going up? Is the price going down? Or is the price going sideways? In my eyes, I'm treating it as a sideways thing. Okay. It's one of these deals, just like I said, you know, if you go on the minimum margin and there's $1.50 in there, you know, that's what, 300, 400, 500%. Okay, but I'm only here talking for it to get to here. Okay, at 4.5. If it goes back over 355, we're aiming. I'm going to say that we're going to go around $3 here. 350, 355. It'll probably go up to 450. Okay. And once we get there, we'll look at it again, kind of deal. All right. So the thing is the first starting point is you have to be able to stay in there. Okay. So one, deep pockets. If you go in there with minimum margin, if it falls 20 cents, you're on call. They pulled your account, all that fun stuff. And 20 cents is we're probably going to do 20 cents on the bottom. How I'm looking at it as, at the low end, it's either going to be 270 or 220, and at the high end is at 350. It triggers you back in as long, but we're gonna probably flop around the $3 level just to see here. But if we do have a massive unwind, you're going to have people who are going to be forced to sell. So that means somebody's going to be on the other side of these things, right? That's the nice thing about commodities. If somebody loses $1, somebody gains $1. It's not like equities where everybody loses or everybody gains type of thing, you know. But with commodities, it flows with prices going back to the reversion to the mean. Commodities, it works that way. And then, like I said, the best thing about commodities, they don't go to zero. Okay, they still trade asbestos in Russia. Bless them. So, you know, I've been doing this for a long time. If nobody wants it, I want it. If they all want it, I don't want it. Okay. So, in this case here on natural gas, I'm looking at it as the past of this area. If you just take a scatter plot of the whole thing, you're in the lower 20%. What do we have here? 1, 2, 3, 4, 5, 6 and change. 1/6. It's even better than that. Lower 10, 12%. Okay. All right. But this is the thing, you know, if you're going to want to catch one of these, catch one of these, you know, outright, you buy it, we'll just say it goes to 2. Okay. It drops another $1. So it goes to 2. You buy the contract, we'll say $20,000 full value, and it goes up to $10. Okay. So even outright, you're making 400%. Okay. But the thing is once you're in, okay, you can start using that, and you know, since you have 100% of it in there, you can begin to go on leverage where you begin to add on every new breakout. Okay. That's a different, once we get to that road, we'll cross it, but there's two ways of looking at it. Your pyramid can be just, you add one contract at a time every time it breaks out because you're going with the trend. You add a contract with the breakout, you add a contract with the breakout, you add a contract for the breakout. Then there's the part where you have enough and you kind of have an inverted pyramid, like you buy one contract on the breakout, you buy two contracts on the breakout, you buy three contracts on the breakout, or you buy four contracts on the breakout. And so your pyramid is a little more inverted here. What happens is you actually get wiped out right before the thing takes off flying. It's basically it. These little spikes here are usually in the last 6 weeks of a movement here. These are monthly bars. All right, so now we'll switch over to the charts. Okay. The other one here, as well, I have your attention, is that the Commitment of Traders report. A lot of bodies talking about bodies in crude oil. Okay, I said crude oil to about 38, and that was prior to all the Commitment of Traders report. Then I saw monthly, I think S2 is around $17. Here's Brent before. Okay, we had a peak in 1980 in oil, we had a peak in 1990 in oil, and then we had nothing. So when I talk about a decade of dead money, this is basically what you're looking at. Okay. Will I think that oil is going to get back to $20 or so? Well, it was just here before we took off. Okay, we have a little bit of inflation in the system right now, but you don't know, there's a calf. Have we all figured out how to stave off a depression? Oh, of course, we're geniuses. So what happens in a depression is everything gets sold off, because the food, water, and shelter. The water you'll be able to get, the food you're able to plant, and your shelter is basically what holds the people. Sell everything they have to hold on to their home. Okay, but it's when like I said, when everything's when you're in a depression, which is an extended period of time of economic malaise, everything gets sold. Okay, so on the oil thing, I wrote about 17. I threw that out there to see what what it would fancy kind of thing. Not much attention on there, so there must be a new round of people out there that aren't following me too closely compared to some of those that really follow me closely but don't say a word. All right, so this is the unwind I'm talking about. That we'll probably see in natural gas, but we're not at this high extreme. We're at the just getting started extreme. But remember that somebody's on the opposite side of the trade. 40 for Brent looks to be about pretty good. Where's our regular crude? What did I miss here? Gas, oil, gasoline, Brent. Oh, our crude. Okay, so our crude is here. So what's this? 20 and 40 is too much. What's this, about 20 to 35, 30s? Yeah. Okay. I'm just trying to. Okay, we have the peak. I know I was just going to talk about natural gas, but here's a peak in oil right in this period here. Saudi Arabia opened up the floodgates, and that was our bottom. That's what we have here. So we may have a deal here where oil hit its high, like up in here, and then we kind of trade lower for the next couple of years. I'm looking for a recession. All right, so that's when I think we'll probably get some bottoming of the commodities here. But as you can see, coming off the peak in oil, it was basically dead money until we, came up with the Iraq, the Kuwaiti war here. But it is, as you can see, it was dead money. We did have a strong dollar during this period. All right, and then back in 1998, Russia defaulted on their debt and basically made the bottom, and then we went off and did our goofiness, and so now we're coming back to, we're normaling out here. All right, so getting back to natty gas. Where am I at? Natty. Okay, so here we have natty. All right, we just got done looking at a big picture of natural gas. All right, here down here is at 161 is a 17-year low. Okay. So I just threw on some lines on here, just a reference thing, okay? So natty gas stalls off about $4, okay? came on down. We got about halfway back. I'm treating this as a head and shoulders. Okay. The next line down here is an S2, which it says about 303. Okay. So it's not really, price really hasn't turned. Okay. For me to come back into this thing, there, you know, basically, what is this? 330. We're back into that area. Remember where we had to deal with excuse me, gaps on the way up between like, what was it? 330, 340, same type of deal again here too. So on here, this is a daily, but I like weekly and just take off your highs here. I mean, you can go in here and go bottom fishing on here, okay? And how I like to look at it is that you're getting forced selling, and it's tough to get into the deferred contracts, okay? So if you're going to have forced selling, you can come in there. I don't want to rule this out. Okay, so because of, I mean, looking at this one, we're talking it's 70 cents from here. You dropped to $3. It's not going to take. You wipe out everyone. Okay, you wipe out everyone if it comes down to about 250. Okay, I'm the lower end down here, and some of the lines around 270. This is where the whole thing got started on the way up. Okay, what I'm saying is save some powder. You know, if by chance we come down to this area, I talked about the 220. If we have a mild winter, this is what I wrote. We'll see the chart, but this is what I wrote for mild winter, which would be basically at the upper end of here. I don't care if we're pumping natural gas. I don't care if all the tanks are full. I don't care. I don't care. I don't care. I don't care. What is it doing? The big picture right now still shows that it's in an incline. Okay, so it's been in a bull market basically for 10 months here. Okay, but natty gas 160 at the low end and 350 whatever, 393 or whatever on the upper end. Okay, it doubled in 9 months. Okay, now now it's pulling back. And you get an opportunity to add into it. Okay, if you're long, depending, you know, we're talking, but remember some of these guys, they're on margin here, right? So they're going to get, you know, if it falters down in here, they're little, you know, the winner didn't pan out for them. So here would be an ultimate target for me. You know, if I put my floor trader's jacket back on, I want to press this. The market is up. I'm getting an opportunity here to force everybody out and gobble up their contracts, okay? So, you know, you're looking at it as a deferred contract. You know, you're looking to try and get in, you know, September, October, November, December, January, February, late 2017 and 2018. Natty gas, 25% of it is used for electricity in the summertime. Okay, we've been switching over to natty gas in the United States since the 1950s. Okay, so we're trying to get out of coal, and we're trying to get it. Natural gas is beyond plentiful. Liquefied natural gas, that's another opportunity out there, because all you have to do is just is turn the tables. You know, I mean, why do I like natural gas? Well, I started because it was at a 17-year low. That was it. We're at that time, we're in a glut of it. Aubrey McClendon drove his truck into a wall. I mean, life is really good for people in natty gas. Okay, and so, but to me, that was the starting point. It just said, somebody said 17-year low, and I'm like, here's an opportunity for me to buy $3 silver again. And then you just have to follow it. The key to all of this in trading is you find one thing and you stick with it. You know, S&P futures, NASDAQ futures, bonds, notes, soybeans, whatever. You find one thing and you follow it. And your biggest mistake is what's going to be in between your ears, and it comes down to money management. All right. I like to sell options against long positions. I like to sell naked puts to get into positions, because at the time the knives are falling, the put premiums are bloated, but hey, I want to buy. So somebody is going to pay me to buy. So it's like a bonus. Yeah, I want to go in and buy it, but somebody's actually going to pay me. All right. And there's good money in selling the options on that way too, because the premiums are bloated. All right. So we have the natural gas here. It does look like we got our little
an intermediate type head and shoulders going on. Daily. Okay, so this is spot natural gas. So this will be the front contract. We have a contract rolling over in the next 6 days. I'm going to assume we're going to have some selling going into this here. And that's basically what's been going on is when we've rolled over the contracts, we've had selling. Okay. So it's kind of like, maybe a week or two down and then trade higher. Okay. If we get down to what are we at here? 350 to 370 level, I'd go buying in some of this year's contracts, say like March and April. All right. But my goal is to try and buy some of the deferred contracts for next year. There is about a 4-year cycle. It's 3.5 to 4 years of a drought in the United States. Usually when we get the drought in the summertime, we get the hard, dry winter, cold, dry winter that follows it. It could precede it or follow it. I always remember that it always followed it because of the drought never turned. That's basically what winter is a drought. You get a lot of snow, but it doesn't amount to moisture. That's basically what winter is a drought. So it's a continuation of the drought from the summer. All right. I don't live in the Midwest anymore, so I'm not as much as in tune with nature. So the next bull market drought-related deal, I'm going to have to play it off the chart, but it'll show the same characteristics. The same cycle works out. The markets are most bullish at the most bullish time and most bearish at the most bearish time. That kind of thing. Everything goes in cycles. Okay, so we have natural gas here. It's been trading up since March. We may get a 1-year low in March. Okay, that happens too. Right now, we had in the stock market, we had a low last year of January, February. We could have a high January, February here in the stock market and then roll over. So what I'm saying here is if you go running into natural gas, try and put in more than just bare minimum margin or shoot for try and write puts under $3, $2.80, $2.70, $2.60 get paid. And if you get put the contracts, then you are in them. Okay. The strategies what you're trying to do is you're trying to buy something at we'll just say a 20-year low, and you have to have staying power and you have to have a plan to get into this thing here. Okay, so you're getting an opportunity. It does look like we're going to get an opportunity that this thing's going to come and slice down here. This says 280. This is a moving average, 200-day, whatever. It's just a line. But if you have deep pockets, it's the same type of deal here. You buy one at 30,000, you buy one at 29,000, you buy one at 28,000, you buy one at 27,000, and you have 100% of margin in. You could turn around and sell the calls against it. Like I said, if this ends up coming down, what do you have? You have 9 months of sideways, basically. You poked its head through, and it came back into the sideways channel. Okay, what I would like to see, though, is, of course, it coming back down to 250 to 270. That would be nice, because eventually what's going to happen is you're going to get this hard freeze or whatever, and the banana heads are going to jump on board. But I'd rather be in it with my risk knowing it's at a 17-year low than to chase after it after it's turned. What do we have here? 272. Okay, these are the point and figure charts. Point and figure, it just has price on here. The numbers equate to like 1 is January, 2 is February, and when you get to 0, then A, B, and C is I think it's October, November, December. Okay, so basically what I use the point and figure charts is it just gives me price. We're all trading on price. Only if you trade options, you're dealing with time, but this is just price. It tells me where it's been and where it's at. Okay. And then this is the volume bars over here. Okay, so basically it tells me that there are areas where I call it happy places. The buyers and the sellers basically were happy at this level. Okay, so 425, 450 would be the upside if we clear this high. Is what you're basically aiming for in this science. Theory, whatever. And this is resistance, okay, and this is support, okay. Then a point and figure
I believe is the best charting format out there because it keeps you in. It's rigid rules. You only do certain things. You can toy with how it's set up, okay? Because of like some of these reversals here. If you get a reversal, like this is the first reversal, you wouldn't get puked up until, like, we're talking 50 cents here. Okay. That's 1/6 or 1/7 of the contract price. That's why I say deep pockets. Okay. You get started with deep pockets, you establish a position, and then you can start adding contracts because you have enough staying power in there. If you're on margin, and that's the thing too, is a 1% move at $3 is different than a 1% move at $6, right? Okay, so if you have the deep pockets in here and you buy a handful of contracts, when it starts breaking out to the upside, you buy on the breakout. One, that helps the situation, and two, you're moving with the trend. Yes, you can do the world famous buy the dip deal. Okay, that's fine too. Buy one there and buy one on the breakout. Okay. But for right now, any pullback in natural gas, I'm looking at it as an opportunity to buy 272. Would be nice, wouldn't it? Okay, so let's just run through some of the contracts here. There's different setups on here. I have some that are the regular, traditional way, percentages, and then average trading range. I'm just trying to get it, for me, like the last one we looked at, it gave me 272. Okay, so I made a little more finite on there. Here it lists up as 270. Okay, so it gives me a range. And then, from remembering the daily chart, this is that area. Okay, so here right now on a short-term basis, this is resistance. So until this red line is crossed, just like here, the game is short. Okay. All right, so here now, percentages. Okay, so, all right, let me see how far back you go. You do go back. Okay. All right, so I talked about a couple weeks ago that possibility that this is a bear flag. Okay, so I'm looking at this as a bear flag. This would be support coming off of like the 250 area. Okay, so support here is about 302. I said 303. There is a little bit of volume here, and you can see back again that the bell curve here is 280, 76, 73 has one. So that's it's the same thing again, where if you get back in the 270, 280 area, you want to look to buy. Like I said though, is that you could have a deal where you have the massive unwinding, and then the winter doesn't work out, and then they pressure to 220. So like trail something behind it, set an alarm up in here, set an alarm up in here, because when we reverse the other way again, I believe we'll probably go over $4 and head to 402, 425, 450 kind of thing. All right, so now we're looking at a monthly. Okay, this is just a cycle thing here. What I did is I just lined up this peak here at 13 and change. It actually poked its way and said, hey, here was the low, and then I'm assuming that this is a 17-year low, the same thing. So then I just basically took up my crayon and do a trend line. All right, now take a look at this one, draw a trend line. It cracked it. Okay, so if we do crack this here, what's S1 on here? It says 226. The list pivot is 308. We banged off pivot already, so it looks like monthly charts way to go on here. Okay, so on here, the next one below it says 226. So you have to have enough staying power. I'm going to assume that maybe 250 to 270 area would probably be a little more giddy on here. Okay, because you can see that as it broke the trend line, it paused on monthly R1 up here, and then it found it on pivot. Here, if it breaks pivot, because of the long legs on here, I'd kind of want to be fishing in here. But what I want to point out is the trend line. So it breaks the trend line, right? Basically trades sideways, okay, in a longer sideways pattern. Got to 6.5, okay? So we're talking natural gas can double again, all right? and in a sideways pattern. Okay, so natty gas comes down to, once it starts doing the two, if it does, okay, they're the whole round number $3 thing, to 294, those areas are going to be there. We're beginning to micromanage this. Okay. We're like, a penny here, a penny here, a penny here, and see, then that's why, the options thing comes in. It says, okay, pay me, 8 cents or whatever, and I'll buy it at $3, that kind of thing. All right, so where am I? Okay, so on the trend line. So we have a trend line, it broke it, and then it came back through and tested it, and that was the high. So I'm going to run this. You always run trend lines forever. Always, always, always. You run them forever. You never know when astronet.com, I think, he has trend lines coming from the Great Depression. That's my biggest worry in the stock market, is that we don't correct the last 10 years, the last decade, we correct the last century. That's my biggest fear. Okay. All right. So comes back basically, a shallow pullback on a previous stopping point, which is around, 250, 260, 270 area down in here. It comes down here, and then a shot back up at the upper range. Okay. But the whole thing is that natural gas looks like we're going to begin to get some forced liquidation, I think, depending upon what happens here. Okay. A lot of bodies are in here. You have to kind of get it started, for what we've seen moving, we've had some pretty massive 20-cent moves, and the price hangs in there. But this time around, though, and we're running into the seasonal thing, I think they're going to be running out of time on here. But like I said, here's 2008, 2009. I look at natural gas as a longer sideways pattern, just like a coil. The coil is tightening, and winding in the energy. The deal is it came down at, it hit 241 and stopped, and 190 and stopped, and, it hit 190 and went to 6.5, and now we hit 168, 161, which was numbers back in here. You can take a look at them, 125, 139, that's the staying power where you can, if we go below 2, then you could put in, then you can begin to think about going on margin because it can only go to 0. You're talking what? We're talking 15 and 3 and what is that? 20%. So you're putting up 20%. You only need 10% down, and you're putting up 20% of the total price, kind of thing. And that's your leverage. Okay. All right. So just running through here real quick. I'm going through these just as you guys are going through them too. So here I have natty gas on a monthly. I just use Fibonacci numbers for moving averages. What do we have on here? 13 months, 21 months, 34 months. Okay. Remember I mentioned natties on there's a 4-year drought cycle, so that's 48 months. Okay, so from peak to peak or whatever. But the deal is this one lined up pretty good here on the blue one. What's that? 13. So that's 13 that you cracked here, and so if it cracked here for moving averages to me are just random lines. If it did with today's technology, okay. Everything has to be programmed into it. You have to tell the algos, what's an extension on a monthly, what's an extension on a yearly, where are they moving at, where are the likely spots, for prices to stall, that kind of thing, and it's all in there per se, and then you work off of volume and everything else on the underside. Sentiment is basically it. I'm anticipatory. I'm not reactionary. What I'm looking at today is what's going to happen tomorrow, not what's going on today. I don't wait for it to move to confirm it. I kind of anticipated coming in and try to figure out what would be the least painful way for me to step into something here. Okay. Like I said, the pivot here on this monthly pivot is 308. We saw some 303 in there. There is some 294. That's the bodies here. Okay, if you're gonna, but the deal is set some alarms on the upside just in case this thing bores. We continue to trade sideways for say another 9 months. If this thing bores you, but if you want to get on board on some of these here, because that's basically what it is you want to be in. We may be having this kind of thing going on. Okay. Where we can't, here's 162, got to 3.25. Well, we did 161 and got to 390. So that's actually a larger move higher. We may be having this thing going on. It's just a whole bunch of selling going on. It's, kind of like this. What month is that? So this is what, October, November, December. Okay, so this was the seasonal high, blah, blah, blah. Here's January and took off running. Okay. Same thing again. Here was the low in 2002 on January, took off running. The following year, that's what we're aiming for. If the winter doesn't show up this year, it'll probably show up in 18 and 19, and that'll also go along with soybeans and grains and stuff. I was looking, some years back, I was looking for 18 and 19, but if it comes up a year earlier, well, my greed didn't work out in the beans and the corn and that. All right, so natty gas. Larger picture here. This goes back more than a decade. You can see that you get your first reversal here. Okay, the whole move down from 6.5 or whatever, came down. We get a reversal up to here. You can see all the volume down in this area. Okay, $5, 4.5. That's the other thing too, is when you get into the natty and stuff, because of the contract rollover, $10. $8.55. That's between us. $8.55 is a target what I'm shooting for, really. I'm happy. I said I'd walk you guys up to $8 a couple of years ago. I said I'd walk you guys up to $8, and then you're on your own, because that's what it is once this happens, it's just, you're in it until you're out. Because it is everywhere. And then you say to yourself, yeah, I have 100% of the margin. I don't have to worry. I got in down here before it took off. It looks pretty on a chart, but it gets a little wretched, kind of like here when you look at here quarterly sticks on here. Don't worry about the yellow. I was just tinkering around. Same thing. I just drew a trend line in here. Okay, I mean, if you look at this, if you have all, 100% of the contract, margin on there, or 100% of the contract value in here, this doesn't look so bad. It just looks like it's a pause. You're saying to yourself, okay, here's an inside quarter. It's only January, but you're catching it. It's an inside quarter, so it's on decision. So you go back and try and take a look at when there was an inside, type of quarter on here. That was a reversal pattern. Yeah, that was a reversal pattern. Again, here's one here. Okay, so you get a breakout. And then you get somewhat of a reversal. It reverses the following quarter and takes off screaming. So in theory, you could say this was a pause, I suppose. Advanced pause. What's the next advance? Well, clearing 4.5. Once this thing clears 4.5 on here, we're going to be off and running again. Okay, because the machines are going to kick into this. It doesn't make any difference. It benefits the producers, right? If oil does roll over, okay, I'm just making a narrative here. If oil does roll over, we're not putting holes in the ground, and I guess natural gas comes out first before the oil. I don't know. See, too much stuff to comprehend. I don't know. All right. But so all of a sudden you stop drilling for oil, and then you don't have all the free natural gas, and then you're a little short on that side of things. I don't know, right? But I do know that eventually here you're going to get a hard winter, and the humans are going to feel this thing, minus 40 degrees in Minnesota, and they're going to chase after this deal. And, and as you can see here, 2002, 2003, 2004, 2005, if you're going to want to get one of these where it runs to $16 or, above 10, you're going to have to go back out into the world and go, OMG, I have to buy natty gas at $6 or $5 or higher to get some of this, and here we are sitting around diddling with ourselves for for dimes and quarters, basically. And here you're going to actually have to come in with dollars. All right. Oh yeah, it's all kinds of fun. The problem with, netty gas, you can't store it in your front yard. Yes, you can buy it in cash and put it in the storage, and then you have carrying costs, as they say. For me, silver starts to go below $5 again, then I start buying 10-ounce bars every week or whatever for a decade. Those are easy to hold on to and then easy to unload. Natural gas, you can't hold on. You're gonna, like I said, your risk is, that's the whole risk thing. Here you have a bar that's from $5. It doubled in the same quarter, and then it opened here, traded up, and came back down. Oh boy! And then everybody says that's a double top, and what happens? Another couple years goes by, and it triples. All right, so like I said, 17-year low on here. The last time it bounced off down here, went to 650. Remember, it broke the trend line and then continued higher. We're going to see how this holds up. What are you? You're in the 90s, aren't you? We'll see how this all works out here. If we get another 20 cents down Monday, you may want to look at possibly you can do spreading, that kind of thing to kind of hang in there. You can lift legs. Spreading is like, say, buy March and sell April, or buy September and sell August. Okay, you're hedged per se, but there is that differential that's there. You can buy options, that just to get your feet wet. And you also have the mini contracts. Okay. All right, so let's just run through here. Quarterly sticks, and just, larger sideways pattern, came across up in here, installed. Maybe it's making a bull flag on here. All I know is it's at a 17-year low down here. This is our first move up. This is probably going to be one of our more, a little decent pullback. You can see the volume. The volume was pretty much that was a pretty strong volume on there. So you have a lot of bodies in here, and you want to try and get it under 3 down here to flush them all out. Like I said, it's the 4.25, $4, 4.5 target. If we take out the 90 again. Weekly, what are we here for pivot? 308 and then 226, 280. All right. What do we have here, though? What's that? 220. All right. Whatever happens, whatever you have to put into your little risk metrics. 260, 270, 220. I don't think it'll go that far. 220, 240. See, I was looking at it since it stalled here, we didn't work very hard up in here. So there's a possibility that this is just a corrective wave in itself. What fund managers have to work with here, because that's it with the risk. It's simple like this, where you just draw your little trend line, and then you're off and running. You draw your little trend line, and then you go, well, we kind of stalled out in here. Well, or like in my case, it's not how far up we're going to go, because that one is pretty much a given. Next time you break through, the angle of ascent increases to, you go from, you start off at 30 degrees, and then you go 45 degrees, and then you go 70 degrees, and then I call it 91 degrees. It just goes straight up and bends back on itself. Okay. I'd personally try and pressure this one here. If I had the funds and I was in the pit here, I really would want to pressure this, because what happens is you get all that volume that the people are in there. They have to puke it out. They're gonna puke up the contracts that you want. But that's my greed side talking. This is, it'd be great to get it back under here, but like I said, there's going to be some around, 290 something, We're going to be looking for a flurry of activity volume wise. So I'll have to switch over to some volume bars here too. All right, so here's our weekly in natty gas. Okay, so we have the low. Basically, look at that. It bounced off of R1 or S1. Okay. Got close to S2 on here. All right, so these are actually last year's data for pivots for this year. Okay, so we're at the pivot point. Okay, so if we lose the pivot, this would be this. The computers are going to say, "Hey, this is support. This is what we're going to aim for." Right? Okay, but you know, we may only get to say 280 and then turn around, and then the people have to chase after it. But you'll begin to see signs of it with commitment of traders and things of that nature. This just kind of, like I said, looks like a bear flag. You know, there should have been a little bit more extension on the running here, but you have a lot of bodies. On here, I'm using unbalanced volume. You can see here the unbalanced volume was at the lower end. You know, nobody wanted it. It traded higher, and then at the high up here, you know, the bodies were in here. MF is money flow. I watched that also, but I prefer the money flow on the future contracts themselves with what I have. I don't know. The unbalanced volume, it doesn't include options, and that's how it's skewed, but for some reason it works out here. And then the next one I use is like RSI, and that's our purple one. And as I eyeball it here, the weekly, we have some divergence going on here. So here I can see that when you look back, here's 2011, 12, 13, there's the most amount of unbalanced volume. Okay, whatever that means, unbalanced volume. So that I just say that the bodies are in there. So more than likely, we're probably going to head back this way. So now I have to go and weasel through all my charts here. And so that was a change on those charts, the Heiken Ashi to the regular ones, huh? So that's kind of a little sloppy, but it worked out real swell here. Okay, follow me on this one. Okay, this is teaching time. Okay, natty gas, these are just regular bars, right? There's nothing funky about it. It's straight up data, raw data. Heiken Ashi, okay, what happens with those is that it uses a moving average. Okay, so you begin to see, instead of the, you know, green, red, green, red, green, red, and all it does is spook you. It's like a pinball machine. It just spooks you. Is it kind of holds on the trend a little bit longer here, huh? If you see a red bar, you like this green one, you don't get spooked out of your trade. But because of the moving average, as we saw back on this one for the peak, okay, we didn't have the screaming unbalanced volume compared to the screaming unbalanced volume that we have here, and we only got to here. But now, when I roll down to this with the Heiken Ashi bars, where does it say Heiken Ashi bars? We did get a screaming peak up in here, so that'll be a nice little sign for when we work off the high here. You know what I'm saying? And these are just correlations to gas and boil and UNL and UGAS. UGAS isn't so hot. Okay, those are backwards. All right. Point and figure again, why I paused was the price came down. We closed here, but what it is it's using both high and low. I would prefer it, since we closed at the low, that we'd have this bar first and not this one. All right, and then why? Oh, it's a high and low for the weekly, so it's just using a weekly bar. Okay, my bad. All right. Because what I'm looking at here is this is a high coming off of the $6, okay, and we cracked it. All right, and basically, in theory, from natural gas down here, so this is a weekly point and figure. Basically, you are long natural gas until this blue line is taken out. What I usually see is the line gets jabbed a couple of times, once or twice on the way up for large moves. When you begin to see, like if this is percentage, it's percentage. All right, so percentage is like a logged chart. The price of natty is way off this line here. In theory, 45 degrees, it should just move nicely, okay? Natty gas is in a bull market until this blue line is taken out. You might get some jabbing of it, like we talked about 220. As time shuffles on, this thing moves higher and higher and higher. This may be around to the 220 area. What's up in here? 228, where it gets jabbed. That would be your buy on here. That would be your riskless buy compared to trying to, figure out where you want to get in on here. What's that? 276. Okay. All right, 255, 52, 20 cents. So that's $2,000. So that's 10%. A little less, 8%. Even if you put up 100%, we're talking, 10%. And when you're talking margin, you're blown out of the water. That's why they call it the Widowmaker. All right, time to go find some. Time to put a fund together and just sit in a room and watch natural gas until it's like, okay, I think it's over with. And then wait. Then go on vacation for 4 years and come back. Yep. D-gas broke through. So D-gas, the buy on here was, the simple one was like 84, 83 on the D-gas, the breakout. Your support is at 403 for those of you that got into D-gas. Okay, contracts. April of 2017 volume bars. How nice is that? Okay, so here we have targets of 306 and 289. What's down here? What are you? 272. And what are you? 270s. I might be tempted to like 280 puts to when the price comes down here. As I might be a little tempted there to because April is out, and I mentioned that if we do get some sort of flush, is to buy in some of this year's contracts too. Because how I look at this here is you have a sideways channel, right? Sideways channel. Well, I guess we could use this back here. We have a sideways channel, broke out, failed, came back into the channel, and then went to the other side. All right, so we go back up. We have a sideways channel. Okay, breaks out, comes through to the other side. Tries again. This is only half back, so this could be like an A or an A, B, C wave. I could kind of lean that way too. It's one hell of a sloppy Elliott wave, but I'll, for the bulls, I'll say that maybe this is a C wave. But take this whole area here, okay, is that it attempted to crack out of it, failed to do so, came back in the larger channel, gave it a go, couldn't do this. So in theory, in my eyes, we're headed back to here. I'd like this line. Try and sell. Go online. I'll try and do it too. Where's my pad of paper? Where's my crayon? April 280 put. There we go. And sell it for a dime. Whatever. Just that. It gets you started. Right. April 280 put. 10 cents. I don't know what it'll be at the time, blah, 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 yada, yada, yada. Deep pockets. Kevin, that's not a very good risk manager. Yeah, well, when he gets there, then we decide, right? You go and you get an x-ray and they go, we see a mass. And then they open you up and they go, there's the sponge from the last time we worked on you. I'm just joking. Okay, so I'll probably say that since how this plays out is, here, and then they're gonna try and pressure down here. I would. Unbalanced volume wasn't as screaming here. The blue line is the ADX, right? ADX is an indicator to tell you if you are in a trend or not. Okay. I started out with, I wasn't a big fan of stochastics. I did like RSI because I was looking for the divergence. And then that one, I would play a 1 minute chart of S&Ps and just play off of the RSI. And then I would have to buy 3 times if there was divergence. I bought the first time, it kind of poked its head, say through 30, and then it would come back again and go a little bit lower, maybe 26 or something, 25, and then I'd have to buy in there. And then the divergence would show up, and then I'd have to go in a third time. So that's how that, and then on the way, all of a sudden it goes tick, 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 get your 4 points and then get out and call it a day. That's the toughest thing for Kevin is if you get it in the first 15 minutes is calling it a day, right? No, there's still 8 hours to go. keep working. No, that's why I'm on the West Coast. I don't mind getting up at 3 a.m. It's the working past noon that I really hate. Living in Minnesota, man, it was dark on the way to work and it was dark on the way back from work in the wintertime. And I'm like, you sit in a skyscraper and stare out from the 36th floor or whatever. And you're like, it's nice. And you get home on the weekend, mow the lawn type of deal, and it's raining. It's like, no. Now I come to a place where the poor kids, they can't even mow lawns or shovel snow to earn funds. So, all right, we'll treat Natty Gas as a head and shoulders for now, and we'll say that they're going to try and pressure this thing. You do have 6 days until the January contract comes off the board. So that may be what we're going to do is we're just going to slaughter them for 6 days. April 2017, we have unbalanced volume way up there. And I have April 2017 and the unbalanced volume is there. Oh, wow. That's quite the interesting deal, right? April 2017, am I missing something? Friday the 20th? Friday the 20th? No. All right, same type of deal. I hope this isn't a double bottom. Well, no, I hope it's a double bottom. That's what I'm hoping for, because then you can get new people in and get them long. August of 2017. So what are we talking down here? 280, 270, 280. Now here, follow me on this one here. So what happened is the people got into the deferred contracts, okay? I'm going to assume everything under the sun is here. So those in the know, what they did is it basically filled the gap. The front contracts didn't have enough oomph in there to fill the gap. So the front end is probably going to get slaughtered. Now you can see the unbalanced volume on here is up here, only 5,500 contracts traded. But in relative, this is what it was before, and it fell back to 280. Okay. So here we're a little bit higher. Maybe it'll stall out right here instead. But what we're looking for is for the bodies to come out. You're looking at people who are going to be forced to sell, and they're going to give up these deferred contracts like this August. So maybe you want to come into at August. All right. August, put August $3 and then 280. I have to follow this and see what I can get. See where it's at, because there may be some time involved here. This is what you have to do. For me, in my end, it's the risk. To me, it doesn't make any difference if you make 300%, 400%, or 500%. You still have to stay in there. So it's the risk. And then that's the nice thing about commodities is they're cyclical. Every 4 years, every 4 years, every 4 years, every 4 years. Whoops, that one didn't work. That was soybeans in 92. You had to wait till 96. Whoopsie. It's like, double cycle. I have to wait 8 years, i.e. the stock market is at 8 years, right? Okay, here's Natty Gas. All right, so earlier in the year when we had our first little dippity-doo-dah and it came through, I think it was my Screaming Thursday email. You got to get into it. You got to get into it. All right. So what I did was I took the previous amounts of pullback and then takeoff kind of thing. This is about 13%, and that's what we did here, okay, on the pullback, 13% here. And this is what I was looking for, okay? This was the push through it, okay? So we got the 13% pullback. The next one is 36%, which would put Natty Gas. I had 320, and that's where we're at now. So 320 in natural gas to 440 is what, 36%, and that's what it did here. From here to whatever here, this move up, and then it had another pullback to the upper end. So it's one of those where, okay, here's another story. What happens if Natty Gas doesn't hold here? If Natty Gas doesn't hold the other end, I talked about 408, but we're talking, I'll use these lines here and a little under, what is that, 416, 418, whatever. When it gets there, I'll update you. For you subscribers. All right. So all right. So I'll use that as a resistance level here too. Okay. So here's this. And then I use the larger move here from when it, wherever it was, from the takeoff, I think from the breakout. I call it a launch pad. Took off, and that's, what's that say, 40-something percent, 60%, whatever. Same type of deal. So now we're up to 520, which is up here is 540. The computers are going to read all these lines, so these are obvious targets. So if you're long Natty Gas, maybe you'll want to sell a 460 call or a 440 call.
just in case it pulls back, and then you collect the call money before it goes higher. But here's the story. Does natty gas come back down to this way, or does it go up to this way? Okay, like I said, it's pointing this direction now. Here it was pointing this direction. Coming into a 20-year low, now we're pointing this direction, but we may have a longer sideways area. But anything through up in here, clearing 4, it's off and running, and then it's just going to be leggy all the way through here. I prefer kind of this nice and gradual thing because you get into the rhythm. I can feel markets when I'm in tune with them. They're a living creature. I can sense it, and it helps out when you go into these chat rooms and you find out the sentiment of the underlying players. If they're all giddy it gets to here and they're all giddy, I'm like, well, write some options against your position. Write some options and calls. If you're wrong, well, you didn't actually get out. You collected some premium. You can always cover the options back, or you can always buy in more and write these options. It comes, like I said, it comes down to money management stuff. If you come running in here and you have 10 grand and you buy one contract, it might be a painful afternoon. You might have to do some spreading and then lift a leg. There's a lot of ways of kind of attacking this, but it really comes down to the money deal, the money management. There's if you're having troubles pulling the trigger, it's scared money. Look, okay, I'm an architect, but I'll never be a home builder. Okay. So for some of you, for me, I've been looking at charts since I was 9, following the markets. I jump on my little box in 2000 and in 2007, scream about real estate and blah, blah, blah. And nobody listens because it's a whole herd mentality. I'm a little too altruistic for my good, truthfully, right? Trying to save everybody else, but they're going to, time and time again, they jump off the cliff. And what happens? They freeze, deer in headlights, and then they ride it all the way down. Just like the time that I told you about the guy that had 9,000% return in Oracle, and he wouldn't get out because he didn't want to give the tax guy a third. So he rode it all the way down. So instead of just making, 6,000, 60 times his money, he rode Oracle all the way down. Okay, so he would rather take 100% or 200 or 300% versus whatever 4,200% because he didn't want to pay the tax, man. I've 40 years of all of this, I've heard it all. And my biggest concern is when your customer segregated funds, John Corazine, it's not putting the numbers on the board. That's not a problem. It's getting the money back from these holes, okay? And that's my biggest issue. For the last 20 years, I've been lucky to skirt people like, well, I guess we won't go into too many names. We'll just say Refco. How about that one? And some Forex guys, and go way back into a lot of these guys blow up. But I've been very lucky, and that's what am I missing here? But okay, we're on natty gas. On balance volume for this, 5-year chart, it's up there. Okay, so if we take some of it out of it, it's unfortunate they couldn't stay in. But I have to lean. Look, 17-year low. Even if it's sideways, that's fine. You still have to get in there because once I'm in there, I'm done. I move on to the next. It just wherever it swings to, I move on to the next one. For right now, I'm looking at the grains, soybeans and wheat, oil seeds, I guess, too. There's natty gas. It does look like it's going to roll over. Wow. Daily. All right. Market's going to open up. Yeah, looks like a flag. All right. What do we have here? Moving average right at S1 at 3. Well, we'll see, won't we? See if we can pull another 20 cents out of here. I don't know what the weather did. Okay, what do I have going on in this chart? All right, so what I did was I took the 190 move, okay. This was the bottom in 12, and then the move to 6.5, okay, in 14. So in 2 years, natty
tripled. Okay, it says 241%. So I took 241% again, from the low on here. It came up to about 5.5. Okay, so like I said, that's what I'm playing. I'm playing this one. 440, 450, 5, and that kind of thing. And then the next one. All right, but in theory, since this made a lower low than this one, it should actually trade higher. So that's why I was looking for 7.5. Okay, so what I'm doing here is what you're doing is you're playing natty gas to try and go to $7.5. Okay, as if it happens in January or February next year, there you have it. So what do we have? That's $35,000. So it's 900%. Is that right, Kev? If you add the minimum margin here's the 300 bold, big screaming numbers, right? So if they put in they buy it $3 and it goes to 7.5. That's $35,000. No, 7.5. That's $45,000 off of their $3,500. So that's like 1,200% in a year. 12 times your money. If you're lucky to just be able to buy in at $3 and that's the end of it. Woohoo! And it just goes straight up from there. You go in an ideal world, you're 12 times your money in 1 year. Less than that, 8 months. 10 months? 10 months. Where are we at? January? 1 year. 12 times your money. That's what I'm looking for. I'm just aiming for 750. 750 is what I'm looking for. Because the whole thing is once you get past 650, right? Because all you're doing is shooting for the previous targets. 450. What did I use? Well, I used the 240% here, and here you are at the 240% there, 550. Well, everyone's going to say they're just going to pull a number out of their butt. 650. All right, you get to 650, then what? Then you go to the next one, 750, and then what? And then 8. And then at 8, then they're all going to woo talk about every number under the planet. That's where I go, okay, we need to figure out an exit strategy. How are we gonna play this on the downside? Like right now in the stock market, it's not about how far up it's gonna go. I already had that one figured out in 2013 when I said it was gonna go to 2,200. My thing is, how low is it gonna go from over the next couple of years? That contract's expired. Okay, moving quickly through this because it's taking longer than I thought. All right, February 17. This one's going to start coming off, so I'm gonna assume here that we're going to try and shoot for $3 on here. This is a little bit deeper on the pullback. These are volume bars. I think we're gonna, with these contract rollovers here, I think we're gonna try and pressure into this area. But the deal is you can't be greedy. You're gonna have to come into some of this stuff. You're gonna have to be able to hold on to it. It's February again. What do we have? January 17. And don't worry about that. I was just tinkering with stuff. It kind of worked. It did. Well, that's the end of that contract. That's where it stopped. Oh, amazing how that happens. Yeah, STEM people. Nothing like STEM people making it an exact science on how to trade, right? Well, I think this is what, don't have it. But the deal is, and the truth of it all, it's what's between your ears. You can't stop the human. You just wait. Wait for when these little STEM guys get taken to the shed with the humans. Because the humans were, okay, bumblebees are not supposed to fly. All the humans with their slide rulers and their stem and all that stuff, bumblebees are not able to fly. I would be thinking about how to get that bumblebee to fly in space, because that would probably be a key. Actually, it's just light. You ping it off something and it comes back with data. All right. Yeah, natty gas. So natty gas, you're looking to buy the dip here on here. I don't know if it's gonna, if it's gonna end up being sideways until 2019. But the deal is if you want to get your fingers, okay. So the 1,200% comes over 2 years. Now you're only earning 600% a year, whatever, And that's remember an ideal world, and that's only at 750. It could still double from there too, right? Okay, here's June. So let's think about this one a second. So 315, 305. All right. So, okay. July. Where are we at? January. So June, July. So summer months. So what is that? Q3. Okay, Q3 under 3. I have to remember these. I have to hire people to sing into my. All right, anything if you can get the third quarter guys under $3, just start nibbling in on it. But Kevin, there's another 30 cents down to here. Well, when natty gas, if it does fall another 10%, then we'll talk about it here. It's Sunday. We'll see the market open up here in a few hours. But like I said, I'm going to treat this as just as a larger sideways pattern that it broke out. And in theory, when you break out and it fails, it comes the other way. All right. And so this is what I'm shooting for. And this is the greed side, but like I said, we're only looking at this. We need the larger picture. What was I looking for? I'm looking for this. Well, then you have the whole world famous, what happens if it's a double bottom? What's this guy? What are you? What am I looking at here? Weekly. Why are you down here? S2, 193. 240. 193. All right. We're gonna have to put that in a huge equation. Well, that's the whole thing too, right? You put in 100%. If it drops down to there, yeah, whatever. You're out 10. You're out a third. But then when it gets down to here, if it gets down to here, you still have what 6-7 times the amount of margin needed in there. So you buy one and you lose a third, but then you can buy 6 down here, and that's some pretty good leveraging. And plus also it's going to mark some time. It's just not going to fall here. But this, when the computer kicks this up, the deal is okay. Sugar one time fell to $0.015, which would mean that where it's at now would have to fall 90%. And what it was the last trading day. They didn't have anywhere to put the sugar but into the ocean or whatever. So sugar just collapsed. Silver did that in 1987. It was $11 an ounce. And on the last trading day, it traded down to $7. Okay, markets have a tendency of doing stuff like that. Like the Minneapolis wheat market, someone was short in delivery and they couldn't find it and they had to pay up. Wheat went from like $12 to $25 in one day. Glencore, if you go look at cotton, how it exploded a couple of years back, that was because these guys who are professionals with billions of dollars let their ego get in front of them and they held on tight. And lost billions of dollars. And every once in a while, I think to myself, I wonder if they just kind of stole it. Think about it. You open up an account overseas, you trade against it, you have this funds under management, which, it's fiduciary responsibility. I'm going to assume fiduciary, as a professional, it is your job to take care of these. This is folks' hard-earned money, man, right? A car to me is a very expensive stereo. If I bought a Lamborghini, I'd have to drive it 600 miles to LA to get an oil change, and then I'd have to drive it back. And then I'd be like, oh no, I have to get another oil change. I put 1,200 miles on it back to LA. So here's Kevin in his Lamborghini, back and forth, back and forth, back and forth to LA. Am I enjoying my car? Probably not. That's how I look at it. I do the little value thing just a little too hard here. 36-room mansion deal. I did that thing too. I set down my glasses and then it was time to leave. And I'm like, hey, only 35 more rooms to look through before I can find my glasses. And I think of dust. All right, running through all this, March 2017, blah, 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 yada, yada, yada. First stopping point around 310 or something, 30, whatever it was. What do we have? 283 for March. There's a March-April spread. I won't go into that now. My thing here is to, oh my gosh. What would be the odds of having it come down to here? Wouldn't that be insanely crazy? Well, I'm definitely going to keep my mouth shut about that. I mean, that is an opportunity. So you have to put this all in perspective here, right? You know, like I said before, set a little alarm off of here. Once we come through here, then we'll probably go through 4 and we're off and running. But, you know, here we are assuming that this is going to be your, you know, this is a 17-year low. Guess, well, this is actually above the 17-year low. So I'm going to have to, wow, that could get interesting. Because see, these contracts bottomed at 250. So they can go below their trading range. Wow, 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 wow. Okay. This is going to be interesting here. Yeah, this is going to be real interesting here. Okay. How am I doing for time? Well, you blabbed for a whole hour, natty gas. It could have been just easy if you grabbed your magic 8-ball and said buy or sell. See, what I'm fighting is the timing of the bull market. But okay, 1987 in Minnesota, we had like 30 inches of rain over 2 days or something. Rain everywhere. The following year, 1988, it was drought. Okay, so in 1 year, we went from a bumper 220 corn, bushels an acre kind of thing, whatever. We went from, $5 beans to $11 beans in 1 year, and that's what I'm looking for. And that's usually what it's like commodities to the apples. If you keep an eye on prices. 1 year, like I asked the neighbors next door that are here, the blizzard chickens, snowbirds. The apples were great this year. Okay, so I'm looking for, they're huge. There's too much of them. There's a glut, and the prices crater. The following year, there's no rain. The apples are tiny, and the prices tripled. That's what I'm looking for. So it's on the timing on here. I need to go find some peoples and work another position in here. All right, Natty Gas Index. I think this was just stocks. Basically double top on here. Sideways. When a market goes sideways, you are going to get a trend either to the upside or downside. That's what it is. Markets go sideways the majority of the time. 70 and 80% of the time they go sideways. You guess 26. What do you got? 26.96. Okay. You guess they keep running in there. Okay. Now they're coming out. Okay. So the deal is, this is the deal. Okay. The spot market, the front contract of natty gas shows a low of 168. The deferred contracts didn't get down that far, so they are susceptible to going through the lows on there. So even though you look at a chart and it says, well, this is the low. Well, yeah, but all right. Okay, I'm gonna have to. The deal is though is now you're going to be able to get those deferred contracts that I was talking about. All right, bear flag here. Bodies are in it. Wow. Well, I suppose that would go. It would go with what you're looking for, Kev. Right? You figure that nothing would work out and everything's wrong. And you would have everything crater. Beans would crater, corn would crater, natural gas would crater, oil's cratering. It goes along with what you're looking for. So why do you feel shocked, Kev? All right, I'm going to let everybody go here. Hold on, where are all my deferred contracts? Natty gas, man. Summary. Natty gas, here are all my contracts. What am I missing here? June, July, August, September. Where's my, whoa. Where's October? V, right there. How did I miss all this? Did I hit the wrong button? Probably. Okay. Oh yeah, that's how you got all excited. Well, happy birthday, Kev. Maybe they give you your October contract at $2. Ooh. which of course is, so that'd be 20 grand. Wow. October. This would be a glorious birthday present if I could get October at $2. Wow. Better keep that one. All right, I'm gonna let everybody go. I'm gonna post this up. I'm gonna send it out, and then I'll do videos on the other markets. Everyone, have yourself a wonderful Sunday. And then, yeah. If it hits the fan, if anything hits the fan, Natty, the stock market, whatever, I can do live webinars, and I'll just shoot you an email, and I'll record it and then post it. It's one of those of, what do I do? It's like, well, I'm sorry you're in stocks and you have to wait. But if you were in futures, you'd be doing it now. That's the whole key. Trust me. We discussed this before. You have a great idea, you get it implemented, and then you can't get out. I.e. Italy and gold. It jumps up $10, and then by the next morning, you're out now $100 later. It's very painful. But you're going to bounce. So everyone take care and talk to you later. Bye.